Today is Monday, the 4th of May, 2026. My name is Francisco Gaffney, and this is my daily streaming all about governance, risk, compliance, and advisory boards. This week, I'm going to show you again the advisory board operating system, how it works in practice. But today we are going to take a focus on valuation, how that helps to value your company. And yesterday I did a post in LinkedIn where um, if you have your property, right, your house, and you usually the normal process of a house is you pay a deposit, then you have a mortgage, and in time, the house, while you continue paying your mortgage installments, etc., etc., the market still evolve. It means actually it has an appreciation of the value of your house, right? Now, imagine that in time you start to do some refurbishment, so upgrades, or to bring it to the next or the most acceptable living standards. And sometimes in property, some things like a very simple, like a change in the front door, the bathrooms, and the kitchens revalue your house right away, because actually the perception of the market is actually this house is up to or above living standards in terms of the basics. So you have a nice countertop, a stone countertop instead of those plastic or DMF countertops. You paint the painting and decoration is different. You arrange your garden in a different way. You upgrade the heating system. Well, you name it. So all these things start to add value to your property. So then the equity portion is a portion that actually, if you had to sell the house today, regardless, you return the portion that is due of the mortgage, but the remaining money of the sale of that house is yours, and that equity value is way much bigger, right? Or again, if you want to remortgage the house to do an extension to make it bigger, so the equity value have a big impact on the future price of your property, right? Because actually these things are calculated when you are remortgaging a house, for example, to do an extension or to do a garage or you name it. So this is about valuation of your property. Now, why I bring this example, because it's very easy to understand, it's very relatable. Who that haven't or who that owns a property have not thought about these things, or their partner have not thought about these things, or frequently they go into these property portals and compare the price of their own houses to the market and say, oh freaking hell, now I have a better valuation of my property, so I have more equity, more value that I actually put in my pocket if I sell the house, right? So this is exactly what I want to talk today, and probably the whole week. No, actually, no. The whole week theme is how to start to look into how you value your organization based on an operating system like the advisory board operating system. And let me pull the model. So we have a graphic. So this is a whole operating system. So if you compare your house, many of these principles in your business are pretty much very comparable, right? So that's what is easier to bring an example of the house to your company valuation. And today we're going to talk about specifically the first quadrant, which is the commercial acceleration, the scaling. So how you put the brand, your people, and your partnerships to work to help you to bring that higher valuation. So this is not a theory, this is not a nice graphic, but it's a working model that boards, founders, and executive teams that want growth, raise capital, improve valuation, prepare for future exits, or pretty much just to have a better company that they say they can be proud of and say, yeah, we're increasing the value of our shareholders, our investors. So from the asset lens, today we're going to talk about, as mentioned, brand, people, and partnership. And from the valuation lens is how you can scale your company, right? Because when you're scaling your company, also you create options. So you have better capacity to choose what to do next. And optionality also change how buyers or investor or strategic partners sees your business. Because when they have options, when they see that they can grow after the acquisition or with the investment, they really like to have a better conversation with you or deeper conversation how they can get involved. So then you start to attract capital, investors, partnerships that before you wouldn't, because your valuation seems to be depressed or smaller compared to your activity. So here is a reality that many founders face today. So if you compare two businesses or two houses, that they have the same setup or the same layout, put it away. So let's stick with the business example. So they said they have the same revenues, the same industry, the same growth, yet receive very different valuations. And why is this happening? Because one might look fragile compared to the other business. So the other one looks more scalable. The other one looks more with one. The fragile one looks fragile, as I mentioned, with more effort, more friction, more activities, and the other one looks more scalable, more adjusted to the assets that they have, the intellectual property, etc. So that matters for our valuation, because this brings you with this brings a company that actually is scalable and can grow. Right now, why this matters, and I give you an example. So I been talking to a company a couple of weeks ago, and they have this very good company, by the way. They have historic product sales, they have annual collections, they have revenue, but their intention is to grow internationally and raise 1.5 million, right? So the founder believes that the market is pulling them to go to another geography and put foot in the US. And that may be true. But as an investor, as a executive team, as a founder, as a board, the conversation is different, the perception is different, and they have to ask it, and they ask different questions. So the first question that they ask is, can this business scale without becoming messy, expensive, or too dependent on the founder, right? And founder dependability, we spoke about this, is not necessarily the classic question, say, oh, if the founder goes and for 30 days on holidays. No, sometimes the founder dependability is, in this particular case, when the founder is in one geography and the business is expanding or growing or setting foot in a different geography. A person cannot be in two places at the same time, right? So we are going to cover all this. That is where many companies get caught. The founder sees demand, the board needs proofs, the investor sees risks, so the buyer sees dependencies. So, and the valuations then start to move down before anyone has even discussed the number, which means that actually when, back to the example of the house, when you see that you are refurbishing your house and you have halfway the processes, so not all the rooms are painted, not all the bathrooms are fully upgraded, not the kitchen is missing electricity, it doesn't mean that the house is not there. It doesn't mean that things are not working. It doesn't mean that you cannot live in there. But there are so many things that are not finished or not tied up to standards, that actually the valuation is not going to be the same as you had a fully finished with all the bells and whistles completed by the time that you start to introduce this company to buyers or to appraisals in the market, etc., etc. Hope these examples start to bring together what I'm trying to say. So let's look at three problems to consider. The first one is a market pull. And I heard this many, many times. A market pull is not the same as scaling. And you have to differentiate what is scaling and you have to differentiate what is growth. So scaling is to have increased the revenues pretty much with the same setup and resources that you have today. Growth, it means actually proportionally to the in revenue increase, you have to increase all your costs, your raw material, your stocking, your personnel, you name it. So one is increasing everything at the same time, costs, put it in a simple words, costs and revenue. And the other one is revenues are going higher, but your cost and efficiencies are staying down. So you have more profits with the revenues, right? So The first problem that I see is the market pull is not the same as scaling, right? Because actually you have to invest to go to another market. So the market pull means people are interested. It doesn't mean that they are going to do it. So the scale means that the business can sell, deliver, support, report, and repeat without the founder being the glue of every meeting. And this is what I mentioned, the founder dependencies. Even if you are in not on holidays and you're working 12 or 16 hours a day, you cannot be at the same time in two places at the same time, right? The second problem is that the founder's confidence can hide the weak operation activities, right? So what I mean with this is that when the founder may say, we are a category creator, we are different, the markets get it. Yeah, it's all that can be true. But, and they might sound very strong at the way, but it does not answer the question that investors or the boards or the executive team is asking. The question is who sells when the founder is not there, right? Because founders have a very, very good quality. They have that capacity to transfer their knowledge, their enthusiasm, their branding, their knowledge of the products and the services to when they are selling or pitching. But then you start to understand who is, they cannot be at two places at the same time, as I mentioned earlier. So who manages the partner, who owns the delivery, who handles the risk, who explains the brand without they turning every sell or every pitch into a founder-led education session, right? So that is the operational depth that if depends on the founder, and they have to be in every place and everywhere to make sure that the companies keep progressing towards the objectives, then you have a bigger problem. So the operationally, they still depending on one person. And the third problem is that capital and exits markets are still selective. So that means that actually, if you don't have the right fiscal setup, the right company denomination in terms of which is this company, a private company, a limited company, partnership, it's a public or towards a public company, which is the legal entity where you're going to see this organization, where are the IPs, where are the operations, where are the intellectual properties I mentioned, where is the royalties, where's the licensing, where are the partnership contracts, etc., etc. You need all these things set up correctly. It's not that the lack of capital in the market, it's a lack of organization and the right sequencing of the things for the market to accept that and say, yeah, we understand this. Now we can help you to grow or scale your company, right? And this is a problem because when companies are highly dependent on the founder point of view, and they say, we reach out to this point, and this is something that I heard many, many times. We reach out to this point, so we are going to continue coming to the market in this way because actually this worked for us. You reach a point where your ways to do things are not doable anymore. Yeah, right. So there are requirements that actually the market sees and expect to see to support your growth or your scaling. So if you don't have that setting up correctly, then you have a problem because you're going to hit your head into the wall again and again and again. It's not because people doesn't get it. It's not because the people have a different view of the world. It's because the world operates in certain standards, requirements, compliance, taxes, etc., that are needed for you to comply with so you can access to that capital, that growth, that scaling that you're looking for, right? So imagine, in other words, imagine this: if you go and scale with the current setup to a bigger office with a separate desk or stand or positions far away from the small office that you've been, with exactly same processes and system that were people that were turning around asking for somebody for something, turning around doing their job, and then turning around and complete the job with somebody on the left. If you go into bigger office and each one has their own cubicle, but are separate like meters away from to the other, that turnaround thing, and it's a very silly example, but actually I've seen this happening. They have to walk to one person, come back, do their job, and walk to the next person to do the job. What do you think will happen with the efficiency of time? is going to drag the whole thing to the point that I say this is impossible. It's very messy, it's very complicated, it's very hard to do because you're not having the systems and processes in place to speed up the things independently where the people are sitting. And you say, well, that is silly, because everybody will see this. That's correct. Everybody will see that a physical example. But when you are scaling your company, when you are growing your company, that is hard to see unless that you are seeing the things from the far away of what is your operational rhythm. So there, you have to ask a different question. So even if the market is pulling, what has to be true for the company to scale, right? What has to be true for a company to scale? And let me show you three things that I, based on this graph now, as what I would propose to consider as an advisor. So the first thing is your brand. So can the market understand the offer without the founder in the room, right? So in terms of branding, and I mentioned this like last week, if you want from one geography that you might be very well known brand in the industry that you're operating, when you go to another geography, who knows you? Is your um, reputation carry forward internationally, or is just something actually happen in your country? When you go to the next country, you have to build the whole branding again. If you go for the route of a distribution, can a partner explain it? Can an investor explain it back to you? If you go to an investor and say, this is who we are, I say, oh yeah, I know you guys. Or, oh, I understand what you do. Can a buyer see why the company is different without needing to 20-minute founder pitch, right? So if the answer is no to any of these questions in terms of branding, the brand is still too founder dependent, right? So you have to consider this. The second thing to consider is test your people. So who owns the next stage of growth? Not is job titles, because job titles doesn't represent, is this next stage of growth? Who is going to drive these things? So in practice, who is doing sales, delivery, support, finances, risk, partnership, investor materials, you name it. So if one person sits across all of it, usually the founder, the company is not yet scalable. It's just busy. And guess what? You already have to do your 9 to 5 job on top of all these things that I mentioned. So are the people prepared for this scale or this growing to move into the next geography? The third thing is the partnerships. So a good partner is not someone who opens doors. A good partner also improves access, margin, trust, reporting, controls. So if the partner only gives you access to the market but makes the customer, the pricing or delivery model harder to see, that is not scaling really. That is a hidden risk because at one point it's going to bounce back to you. So what is it, what you do with all this information? So if you are a founder or executive team or a non-executive director in a company and you see that you are carrying the brand, the people systems and the partnership stories, what exactly the company is scaling, right? Because if it's all dependent in one person, in one team, on one executive board, then what exactly are we scaling? And you have to consider this question very, very thoroughly. So let me explain what I can do to help here. Is three things: outcomes, business outcomes, differentiators, and risk reductions. In terms of business outcomes, I help your teams to turn founder ambitions into 90-day scale readiness plan. So that means the company moved from the market want this to we can prove the brand, the people, and the partnerships are strong enough to carry growth and scaling. In terms of differentiator, I built a rotating international advisory board. And you say, why rotating? Well, this is all around your milestone for the company. And rotating is because you need certain talents at certain stages of the organization. That could mean market entry, commercial acceleration, capital readiness, partner strategies, valuation, positioning, and board level growth control. So you get the right capability now for where the stage of the company is, and then we can swap members. So it's not a fixed hire that may be wrong in 6 months' time. And when I say may be wrong, I say might be it might not be provide all the value that you require or the expertise in 6 months' time. And in terms of reducing risk, is exactly this. International Advisory Board is an operating system that reduces three common risks. The first one is hiring one expensive executive too early. The second risk that it reduces is paying a larger consulting firm to produce a heavy report but not actionable steps. And the third risk that reduces is leaving the founder to carry the entire growth story alone. It has a full board that can help him to bring the story far and beyond than the capacity of one person. So members can be swapped, as I mentioned, every 6 months as the project evolves. So the expertise changes as the problem changes. This is very, very flexible and very fast to achieve. So one action that you can take today and is doable in 30 minutes or less, for your next meeting, ask for a one-page scale readiness scorecard with 3 columns: brand, people, and brand, people, and partnership, and put a color code, the traffic light color code, red, amber, and green. But beside each color is a justification or evidence. So what make our brand go for it, like a green? So you have to provide the evidence. We mentioned many things here, so you can look into what evidence suits your company. And the same with the people and same with the partnership. If a red, probably you need to look into evidence that actually that's a good idea and how to continue it. If it's a green, you can go for it. If it's an amber, probably you need to have a second thought there and a review of this is what to do or what is the requirements to make this a success. So if you are a board advisor, a non-executive director, you are in an executive team, or you are a founder, and you want this international advisory board to help your organization to test, scale readiness, improve valuation, improve, and build the right capability around your next growth milestones, let's have a 30-minute call so I can understand where you're today, what you want to achieve, and how a rotating international advisory board can help you move faster without hiring one permanent executive or paying big consulting overhead. So let's pause here for today and reconvene tomorrow, because tomorrow I will move from scale to predictability, because a company does not get a better valuation because the story is exciting. It gets a better valuation when the revenue, the assets, and your partnerships become easier to trust. Excellent. Have a great day, and I'll see you tomorrow. Thank you. And